Does everybody hear me all right?
They can hear you and they can see you, and looks like we are all good to go.
Beautiful, beautiful. Thanks, Jeanette, and thanks for having me this morning. My name is Rob Mitchell. Excuse me, and today I am presenting for you trading high percentage power divergences with order flow. And these are methods that we use in the oil trading room and on a daily basis, and it's a lot of fun trading in there. We got a great group of traders in there, and I'm going to go over some things that we do in there that are very powerful and also that have known percentages associated with them, which is a really nice way of trading. It puts you in the future rather than trading reactively or wondering what's going to happen. If you're making the right decision, and that's kind of a game changer for a lot of people. First off, past performance is not necessarily indicative of future results. There's a risk of loss trading futures. In today's presentation, we do this in futures, but it applies to any market. And so I'm going to go over some reasons why we do it the way we do it. And because it's a really great learning environment and it's fast-paced, gives you lots of opportunities to learn. But as this disclaimer says, past performance not necessarily indicative of future results. You want to use risk capital for trading, because I've been training traders for about 4 years now on a full-time basis, and I've just found over and over again that if you're trading the money, it's not as good for you. So it's best to trade the process of what we're doing. So today we're going to be talking about things that are connected with the process and that open the door for you to have some feedback and to know what's happening with your trading, not just while you're doing it, but also before it even happens. Okay. Again, excuse me, my name is Rob Mitchell. I've had the opportunity to be a trader for many years now, about 27, 28 years. I've been a trader full-time. I've had the wonderful opportunity of making my living as a trader over the years. And about 4 years ago, coming up on 4 years, I think this year, some people followed, caught up with me and asked me, hey, would you do a trading room? And at first I was like, oh, I don't want it to, mess with my lifestyle. But we finally opened the oil trading room, and it's just been amazing what's happened there. It's just been an amazing environment and everything else. I have a degree in experimental psychology, which is based in statistics. And so I use statistical methods, but a lot of times I find traders find that word to be a little bit scary. It's not natural to think statistically, but I've learned a way of just kind of narrowing it down to some simple methods and ways of understanding numbers, etc., that can really help you a lot. And so my company is Axiom Research and Trading. I'll give you an email and things like that in a little while. But I'd had the opportunity over the years to trade very large and to have a burgeoning commodity trading advisor business and registered investment advisory. And at one point, and several points actually, being the largest E-mini S&P trader in the world. And these days I trade mostly for my own account and develop trading systems. I'm kind of like in a retirement mode, but I'm also a neurolinguistic programming trainer, and I use methods because a lot of times traders have some difficulty in the psychology part of the trading. We're not really going to talk a lot about that today, but in the normal action of the room, a lot of times we're talking about things that have to do with personal development and just ways of thinking that open the door for bringing more abundance into your life. So big picture, what are we going to cover today? Number one, we're going to cover how order flow leads price movement to help manage risk and also to open up opportunity for you. I'm going to show you some patterns that are between 68 and up to 100% accurate, and I'm going to show you how to combine those probabilities to get even higher win percentages. We're going to discover how to know when the majority is likely long or short biased so that we can be on the right side of the market from that viewpoint as well. And I'm going to show you some trading secrets that make and break a lot of traders. You don't want to be on the wrong side of these things when they happen. And a lot of what we do is we work with the notion of traders being trapped on the wrong side of the market. I call it the trapping cycle. And what we want to do is we want to align ourselves so we're not on the wrong side of the trapping cycle, because that's markets naturally will trap traders and get them thinking on the wrong side, and then boom, boom, it nails them, and their stops propel the market in one direction or the other. And that's usually you want to be on that side, because when that flood of stop orders comes in, it helps to propel your trade in the direction that you're trading. So the methods that we're going to discuss today can be used in any reasonably volatile market and also in the intraday time frames. So how order flow leads price movement to help manage risk. So I'm going to talk today a bit about an oscillator that I created as a proprietary oscillator called the TradeThirsty oscillator. I might refer to it as TTO. And it's one of the main tools that we use in the oil trading room, the TTO. And this tool has thousands and thousands of hours of member refinement associated with it. A lot of times our members are doing research studies and things like that and figuring out statistics for various patterns, some of which I'm going to show you today. Various patterns of order flow repeat over and over and over again all day long, trapping traders on one side or the other. And so this can show you where, we're going to look at some screenshots of these in a minute. It can show you where traders are trapped on the wrong side of the market, or where the market's breaking out and one side or the other is dominating, long or short. Order flow readings on this tool tend to lead price higher or lower with known probabilities. So it tends to happen before. Doesn't just tend to happen. So we'll look at some of those patterns too. And so when the TradeThirsty oscillator breaks or leads out to one side or the other, you don't want to be against it, because the probabilities support continued market movement in that direction. This can also help you to manage your trade. You know when to manage your risk more tightly, or to leave it open and let the trades run. And just putting it another way, when to hold them or when to fold them, to use a poker kind of analogy. So to do this, we use the structured Smart Renko price bars. So the price bars that I'm going to put on these charts for you are called the Smart Renko bars, and this type of a bar is structured. A lot of people don't really think about it, but when you choose a bar type for your chart, you're making a decision about what you're filtering. A bar is actually a type of a price filter, and it can make a huge difference in what you're able to see on the chart. So when we use these types of bars, it helps us to see places where the market's going to reverse or continue. And as we see the screenshots and things like that, you'll know. But just be aware that we're using a certain kind of a bar that helps us to see patterns in the market. So patterns that are 68% to 100% accurate. So we're going to cover some non-simple TradeThirsty oscillator patterns. Actually, I must have, did I miss a, oh, here we go. I accidentally jumped a slide. So how order flow leads price movement to help manage risk. This, in the second panel down here, is the TradeThirsty oscillator. And so when the TradeThirsty oscillator is just simply breaking its structure, I have a tool on here that draws these lines on here. And when the trap trader oscillator breaks that structure, the market will tend to continue in that direction. It's telling you that the order flow here is strong to the downside, very, very strong. And then you get this pattern right here, and it breaks again. When it breaks again, you'll tend to see upside movement. When it breaks again, you'll tend to see a bit of downside movement, and then breaks again, continuing up. And so when it breaks to the downside, you expect lower, and when it breaks to the upside, you expect it to go higher, and you expect it to go lower, you expect it to go higher, you expect it to go lower, and you expect it to go higher. And this is without regard to trend. You see here the market comes up strongly, and then it comes back down, but you don't get any break. And when you don't get any break, you know that when it reverses back up, it will tend to continue the trend. Then it breaks lower here. The market goes down a little bit. Trend, of course, being up here through here. It breaks lower right here. These are traders just taking profit as the market goes higher. And breaking again higher here and following through. And so I'm going to show you in a little bit how this will help you to trade with the trend in particular, just repetitively, boom, 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 trading with this. Now you didn't get a break over here, and so when you don't get a break, you expect it to just go higher, so you know that it's okay to hold through this region of the chart. And then I'm going to show you some more complicated patterns in a little bit, but this is just the basic idea of breaking. Now I can get into a little bit of detail on this. It's a kind of a pattern that we call slow it, stop it, reverse it. As the market comes down, you get a long leg and then you get a short one. But while the market's continuing down here, you see that the trap trader oscillator is actually getting accumulation. You can see that traders are buying into this. And then as it breaks higher, that's the trigger that lets you know it's likely going to continue right there. And so these basic readings on this trap trader oscillator help you to see, and it's something that you can't just see by looking at the chart. It helps you to see where the market's under accumulation or it's under distribution. And so a lot of times we might just look at price, but it doesn't tell you what's happening inside of that price. And so this is a view inside the price. And down here in this third panel, we have the smart momentum indicator. I'm going to cover a couple of things with that a little bit later. But this is just a basic breaking kind of a pattern that you'll see on the trap trader oscillator that tells you what traders are doing inside of the price structure. Sometimes the market might come down a little bit, like it does right here, but there's no strength in it going to the downside, and the market continues higher as it does that. So those are the basic just kind of breaking patterns, but now I'm going to show you some non-simple trap trader oscillator patterns. And so far we've just looked at breaking patterns, but often simple breaking patterns are associated with more advanced patterns that have high continuation probabilities associated with them. And one pattern that has high probability associated with it is what we call the TTO box pattern. And we've actually already looked at that, but I'm going to point it out to you in just a minute. The TTO box pattern, based on current probabilities, follow through about 84% of the time without regard to the trend. In other words, if they're going with the trend, it'll tend to continue up 84%. And if it's going down, it'll tend to go down 84% without regard to the trend. If you trade with the trend, those numbers can be a bit higher, but I just make a generic measurement of that at 84%. Now, a boxing pattern occurs when the trap trader oscillator is going counter to the price. And I had mentioned a moment ago this kind of idea of slow it, stop it, reverse it. You're going to tend to see these trap trader oscillator patterns like the TTO box. You're going to see it going where it's going to start showing you that there's accumulation to go higher or distribution to go lower on the chart. And so we'll take a look at that in just a second. So there's two forms of that then. You've got the one that's with trend, and then you've got the one that's counter trend, going against the trend. And so let's look at some examples of the TTO box pattern. On this chart right here, we get this slow it, stop it, reverse it kind of thing. The market comes down like this, and then this bar comes up here. It comes up here, but it's not very strong as it does that. It's not very strong as it does that. It's not able to get much buying. It's telling us that inside of this bar, the buyers are quite weak. And then this bar comes down. This bar comes down, and you get a correspondingly even smaller excursion, which is causing these two dots to go a little bit higher here. And then you get the lead out, where the trap trader oscillator is actually broken above that magenta line I drew on there for you. And so that's telling you that the market's under strong accumulation right here. So you get slow it, stop it, reverse it. And while these three bars are at the same price level, this green bar here is at the same level as this green bar here, the trap trader oscillator is actually leading out. And where's it leading out to? Oh, it's leading out to over in the region over here someplace. So that tells you that when you fire on that bar, you're actually getting into the market at a discount. And we expect about 84% for it to continue through and follow through on that. I have another TTO box pattern right over in here. There's actually another one right here, I'm sorry. So market's coming down here. And just come A, B, C, D, just kind of zigzagging down like that. And at the same time, you're getting the same thing. In this particular case, due to the structure here, this trap trader oscillator is leading out right here on this bar, telling us it's about 84% to go higher. But at the same time, this level is above way over in here. So this is telling you that you're getting a discount that's even more than this one over in here. That it should at least go up into here, and then 84% says it will continue. Another box pattern over in here. We call this I call this a 5-tick trap. It's just a word that we use to point it out. The market comes down, and it's not able to make a strong excursion right there. So it's telling you that this is really weak coming down here compared to what it was before. So you get strength, weakness, lead out, and follow through. Another box pattern right here going against the trend. You go A, B, C, D coming up here, and you get a nice strong lead out right there telling you there's really strong selling coming in right there, and boom, 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 it goes down. Then over in here you get that same triple bar pattern again, and then it leads out a little bit down below here, and the trap trader oscillator leads out again, this time again with the trend. The trend is going up here and leading out again here, getting in at the discount, and 84% going higher. So these are all example in some measure of counter trend patterns, because this is coming down here and this is going up against, but the bigger trend of course is upward, and so it follows out that way. We know that the trend is upward by the time you get over in here. Our smart trend line tells us that the market's going up here by the time you're into here, and so this is an example of a counter trend. I'm going to show you how these work out on a chart where you're going just with the trend. I think I've got one of those in here for you as well. So, excuse me, the box patterns with trend, you can do them with the trend, and the trend line that I just pointed out to you will have an even higher win percentage. But I just use 84 for my statistics. I always choose a lower number than I'm really expecting to happen. But on quite a few of these patterns that we use, we have a TTO box pattern. I'm going to show you another one in a minute. They run from about 68 to upwards of 100% depending on the circumstances. And so I'm going to cover another one for you here called the 3-dot pattern. I like to use the 3-dot pattern to show you because it's just really easy to see it. You just, wow, it just sticks right out in your face. Now, the 3-dot pattern is about 75% accurate without regard to the trend. And a little bit higher with trend. So same thing, right? So simply look for 3 dots going in one direction, and then you want to trade in the direction of the dots, because it's not just saying slow it, stop it, reverse it. It's kind of saying slow it, stop it, reverse it, slow it, stop it, reverse it, go, right? And I'll show you, let's take a look at some of those. So anytime you see 3 dots going higher or lower on your chart, you expect the market to go higher right there, 75% to continue higher. Now this one's kind of cool because that's also a TTO box, so you're getting a double pattern right there. You have 84% on your TTO box pattern that we just covered, and you're getting 75%. I'm going to show you how to combine those for combined probabilities in a few minutes. We're going to cover that. Here's another example, 3 higher dots and go. 3 lower dots and go. It's just super, super easy to see that. Super easy to see that. 3 lower dots. And then again, if you do that with the trend, you know, you expect the percentages to be a little bit higher. But as mentioned, I like to just use the lower numbers. So the 3-dot pattern is about 75% without regard to trend. Combined with other patterns, you can get it even higher. So I'm going to show you how you do that. So if you get a 3-dot pattern and a TTO box pattern at the same time, which I've already pointed out to you, right? These statistically combine to 94% probability of continuation. Why? Well, because the 3-dot pattern is 75% and the TTO box pattern is 84%. And when you combine those together using a formula that was created by a Presbyterian minister named Bayes, Reverend Bayes, you get 94%. So the formula for that is right here, but you don't even need to know that. I just put it there. And you can put it into a spreadsheet that I have called the Bayes spreadsheet. And so when you input those 2 probabilities, you get 94% on the spreadsheet. And at the end of the webinar, I'm going to give you a copy of the spreadsheet so you can use it. Okay. So sometimes these guys will add up to close to 100%. Actually, sometimes they'll go to 100%. Depending on the circumstances. So trading this way is a lot of fun because it puts you in the future. You know before you fire what the expected follow-through is. And the reason that I've approached the market this way is because most traders, including myself for years, are just operating in the past. We're simply reacting to market conditions. If you make if you have this kind of technology and you know what these things are, then in the cases where you're wrong, you still know you made the right decision. And this is, you know, this gets into the trading psychology a lot. So a lot of times what will happen with a trader is they will fire a trade and they won't know if it was right or wrong to start with. And then if the trade ends up being wrong for them, number one, they don't have a feedback mechanism to know whether or not they made the right decision. And they become naturally fearful because they don't know if they made the right decision. And so there's no feedback mechanism for learning or advancing your skill. But with this kind of method, if you got it wrong, you're like, oh, okay, well, you know, it's 84%, so that was one of the 16 out of 100 that's going to be wrong, right? So the next one's going to be right. Now I can continue doing that. And oh, by the way, while I was in the context of trading in that pattern at 84%, I knew that things were stacked in my favor, and you can get just a whole lot more relaxed about your trading than you would be if you were just kind of wondering and not knowing, and then not having a feedback mechanism for learning. And then, of course, if you have no feedback mechanism for learning, you get into fear and all kinds of other negative emotions that you really don't want to be participating in while you're trading. So it frees you from that reactiveness or just being in the past tense while you're trading. It's really very nice to be able to do these kinds of things. So with this kind of trading technology, you have a good idea what's happening before. And as kind of alluded to earlier, you also know during a trade, you know, if you're starting to get that lead out in the opposing direction, you're like, you know, I'm trading, you know, 3 or 4 lots here, and you can see it's coming against, I better take a little bit off and protect myself, right? I'll wait for a reload. So as mentioned at the end of the webinar, I'm going to give you a copy of the spreadsheet, but you can combine these things on the spreadsheet and get some really nice probabilities for follow-through. Discover how to know when the majority is likely long or short biased. We use a concept in the room called the needle. It's just a general kind of way of thinking about the market and knowing and understanding if the majority is on your side or against you. So if there are traders that are trading in a higher time frame than you, they probably have more money than you do because they don't want to mess around with the little stuff. They want to go for the big stuff. And when I say big stuff, I just mean that they're willing to take more risk for what it is that they're pulling out of the market than you do. So, you know, the idea behind this kind of trading is that you're able to manage risk on a very tight basis. And what happens when you do that is your win percentages go way up because your losers are small and your winners tend to be bigger. So one way we use a tool like this, another thing that we can kind of add to the equation is a tool I developed called the 3-period probability walk table. I'll tell you a real quick story. Years ago, I met a trader, and he was pulling about $1 million a year for his own private account out of the S&P futures. And he was very open, and he shared with me what he was doing. And this was back before we had a lot of computer technology. What he was doing was he was taking screenshots and printing them out on clear acetate on his printer. And then what he had a stack of these things. They were patterns, okay? And so what he was doing was he had a stack of these things sitting on his desk, and he'd take the transparencies and he'd hold them up to his charts on his monitor. And he called that market mapping. I was absolutely fascinated with this. He was an accountant, and he was very precise in the way he was doing it. And so from that time, I became obsessed with this idea of market mapping. I had transparencies all over my desk and taping them up on the screen and getting pattern matches and things like that. But the things that I'm showing you today are more advanced methods of doing that, where you're not, you know, having to go sifting through a pile of transparencies. And then further still, we have probabilities associated with them, which is kind of a form of back testing that you do it with. But anyways, the 3-period probability walk table is, that I'm going to show you in a minute, is a form of market mapping that's very, very powerful. And it's a lot of fun to use this because you can also input that into the base spreadsheet. So now you've got more inputs and you can get even, you know, higher probabilities. But what the probability walk table does, or, you know, mapping, is it lets you know the likelihood of continuation under any given circumstance. So often when you get a 3-period probability walk pattern and combine it with one of the patterns that I've shown you so far, like the box or the 3-dot pattern, or other patterns that we use in the room, the theoretical probabilities can exceed 100%. So let's take a look at this table and see what it's going to tell us about what the market might do in advance. This table right here is a 3-period probability walk table, and this will help you to know if the market's biased long or short under any given circumstance, and how likely it is to continue. So one that I like to trade every day happens IJK. Those are the last 3 30-minute periods of the day. Last 3 30-minute periods of the day. And so I'm just looking at this percent table right here. So what will happen is if the I period of the day, that's the third 30-minute period before the end of the day, gets broken on one side or the other from in the next period, the J period. In other words, the J period, let's say the J period breaks above the I period at a given point. I know right then and there that it's 86.67% that the market's going to continue higher into the final 30-minute period of the day. Final 30-minute period of the day. I got some more of those earlier in the day, and I've got some, anything that's bigger than 69%. I have this highlighted to show you anything greater than 79%, but anything that's greater than 68% is usable. So this one will BCD, all right, and so if the B period is broken, then it's 70%. Basically, it's going to continue. CDE, it's 71%. And the market gets quiet in the midday during the lunch period, and then you start picking up 69s and 86 on into the end of the day. So let's take a look and see a little bit more about this. A 3-period probability walk table that we just looked at is a generic table. And we have other 3-period probability walk tables that map out for each day and each interval or each period of the day. So I might have one for Monday, I might have one for Tuesday, I might have one for days that have certain reports that are happening, this kind of thing. And so, because of that, what we have is a market map that shows you in advance what the market's likely to do with a known probability. And so the table has some other information in it as well, like it'll show you what the ranges are for that interval. So range expectation for that interval is a measure of opportunity, right? How much opportunity is there in that sequence? So if you know the range expectation and it's presently not met, you know that you have more to go. So smart traders know that the market has more to go, and that means that that particular group of traders is trading, say, to the long side. They're more likely to get engaged in that market action if there's still remaining opportunity in it. So, but if you've exceeded that range, sometimes your risk is a little bit higher. So what do? Oh, well, you can manage your risk a little bit more tightly than you would if if it hadn't been met. So, but what this does is it gives us a generalized bias of participation for the long players or the short players. I'd mentioned a little while ago the needle, and so what we know there is that more players are likely to continue in that long direction in the example that we are talking about. So if we align ourselves with that bias and we can position our trades in such a way that those traders are helping or pushing our trade to success, that's a really, really good thing. And like I said, anything greater than about 68% on the table is usable. We have a lot of things, upwards of 94% on the probability walk table on certain And so the table analyzes the data of participants that have more money or that are trading in a higher capacity to move the market than we do. And so we're smart not to fight them. It's also a form of trend analysis. You could think of it from that viewpoint as well. It's a form of trend analysis, and as mentioned, it's a form of market mapping. And it's telling you what the market's likely to do in advance. So let's see. And so this is a needle. So I know that I've got a walk there. Oh, it's 84%. It's going to continue IJK, for example, and it had broken to the up. Our bias to the long side in that situation. So then when I go in and I use my order flow patterns to find that, then it's even bolstering even further the likelihood that the market's going to continue in my direction. As mentioned, again, this helps you to operate in the future. You're thinking in terms of the future, while you're trading and not being reactive to little market fluctuations that might be occurring in any given moment. Trading secrets that make and break many traders. The trapping cycle. So, I had mentioned, at the beginning of our discussion, trap trader oscillator. Why did I, name the tool that? Well, because the market is constantly getting traders on the wrong side and humiliating them over and over and over again. And so the market's just really good at doing that. In fact, you might even say that the market is a device for trapping traders on the wrong side of the market. It's kind of, a form of comedy if you think about it. Just gets them on the wrong side and nails them, gets them on the wrong side and nails them, gets them on the wrong side and nails them. Now, why can I say that? Well, I speak from experience, right? And so, my mission over time was to find a way to be on the right side of what I call the trapping cycle. So we looked at examples earlier of the trap trading oscillator telling us where to stay long or short, or to be long or short. And so that's based on order flow analysis, which is great because order flow tends to lead price action. But there's another kind of analysis that lets us know which way the momentum is cycling. That was that third thing in the chart. We'll look at another chart. This is something that you can't see just by looking at the chart. And the basic pattern is if the market is cycling higher or lower, we'll use higher. We'll talk about it from the viewpoint of higher. The momentum will tend to fade or go the other way, away from that. So if the market's going higher, the momentum goes the other way. Okay, we'll look at an example. This is true because market range expansion is preceded by cycle expansion. This is something I learned early on. This single thing is what made it possible for me to become a successful trader. So, I'll say it again. Market range expansion is preceded by cycle expansion. Market range expansion is preceded by cycle expansion. It's like so powerful, but so subtle, and when you see it happen over and over and over again, it's just astounding. So to get to this level of analysis, we use the Smart Momentum tool, and that also helps us to know in advance. So let's take a look at like I said, if the market's going A, B, C, D higher, we're just going to use it for a higher example, just to keep it simple. The market will tend to continue when the smart momentum is going in the opposite direction. And then you'll get a color change on the background of the chart, and then you go with it. That pattern on its own, without any other considerations, is about 80% accurate. And of course, if you combine it with other patterns, as we've shown, like with Bayes and things like that, you can get those numbers even higher. So we saw earlier the 3-period probability walk table. So let's revisit that for a second. We saw that the market goes in a sequence higher. We're going to use higher for our example, 86% of the time during IJK period. Now, I'm going to show you that when you put the smart momentum pattern described above with a TTO pump, which is just where the TTO is below the yellow line. Those will combine to 97% on your base spreadsheet. So first, let's take a quick look at the table again. Once I is broken in J, it's 86% to go higher in K, right here, IJK. IJK. There's a bunch of other cool stuff I could show you on this table, but we won't have time for that today. So 86% continuation. So here's I period right here. I have these yellow boxes just show the periods, right? Here's another one for J period, and there's K period right there. And so this is what we expect to see. This is a 30-minute period, again, just reiterating that. 30-minute period, 30-minute period, okay? And so once I period is broken, which happens right here in J period, I expect the market to continue higher for pretty close to the next hour, okay? So once I is broken in J period, it's 86% to go higher in K, right? 86% to go higher in K. That's that number right there. Just kind of mapping that, right? All right, so what we do is we get the break. You get the break right there, and then you pick up a 3 higher dot pattern. Now, I had mentioned that you'd want to see the smart momentum going lower there, and you do. So the market's going up, a little retracement, comes up, takes out the high, comes back down inside this, forms a little double bottom right there, and the momentum's going lower. Momentum's going lower. And so you pick up the dot right there, you got 3 higher dot patterns. This one, as I mentioned, on its absolute own, 80%. This one's about 75%, and then base, or the 3-period probability walk, is 86% to go higher. Under these circumstances where you're getting 3 of these things lined up, so, you know, what do you have? You got 3 things going on here. You've got the probability walk, that you've got the order flow is supporting the price movement. The order flow is supporting the price movement, and this tells us right here when this is going lower, the cycle's expanding. I got 3 things lining up in my favor right here, right? And then I expect the market to come up higher through K period and go above this level here as a minimum. There's another example right here. Market's coming up, retraces a bit, comes back down. I get this, call that a TTO pump when you go below the yellow line right there, and the momentum is going lower. Between this point right here and this point right here, the momentum is lower, tells us the cycle is expanding, and these two combines about 84%. And then I also know at this point that K period should take out that J high with high probability, so off it goes, right? Then you just manage from there. Then you can start seeing the selling coming in over here, and you know you probably don't want to continue holding that. It's a beautiful thing. So I've got 84% for the pattern there on the right. That's the this guy, 84% for these two. And then I pick up the 3-period probability walk table, and I don't actually have to key it into the spreadsheet anymore because I just kind of know these numbers, right? You get 84, 86 is 97. Now that one earlier, the probability was even higher. I got 84, 75, and 86. I could key that into the spreadsheet and would get a number like 99 or something like that. But in this particular case, on the second one on the right there, 97%. So if you take that trade, you know you're doing the right thing. So we do all these things in the oil trading room, and some of the guys that talked me into starting the oil trading room, like I said, about it's going to be 4 years this year, have greatly participated in the expansion of these kinds of technologies for trading. It's a lot of fun. And so we're basically trading just price action patterns. The market's cycling up, and you're looking for the cycle expansion on the smart momentum and the trapping on the trap trader oscillator. And so on a daily basis in the room, we learn patterns in those. And I think there's probably about a dozen trap trader oscillator patterns that we use, and I've shown you a couple of them today, and the smart momentum patterns. And so we learn that in the room every day, and we discuss it in great detail. And then I'm in the room every morning for the first couple hours, and then I'm there by chat, and it's member-driven, and a lot of the members really know what's going on and helping other traders. So in the room, we learn secrets of trends and price action, cycle expansion, range expansion, traps, lead outs, and more, and kind of putting all this together. So it's kind of fun. It's kind of like solving a puzzle, but the fun thing about it is you're solving the puzzle before it happens, and then positioning yourself to benefit from that. We've got a lot of content in the room geared around, as I had mentioned earlier, around personal development and personal growth that helps to make you independent and at cause in your life. When you're thinking forward in the future, it's just a huge game changer for traders. So benefit from everything we've covered here today on trading room charts and a lot more, and it's applicable in any market. So I'd mentioned earlier I was going to tell you why we do this with crude oil. I've been teaching trading for a number of years and just kind of giving back and having a lot of fun with it. We got a great room with a lot of great traders and a lot of people participating and sharing their insights. But no market gives more consistent patterning than crude oil. It's just super easy to see it. We've gone over some examples today. I didn't cherry pick those. They're just patterns that happen over and over and over again all day. But crude oil tends to make these movements frequently, so you get a lot of samplings, so that you can install these things into your consciousness in the room in a pretty short order. I had on one chart on Thursday, maybe it was Wednesday, I had 45 patterns occur on my chart in the interval of the day. Now, that was on a pretty fast chart, but what I'm getting at is 45 is a huge statistical sampling. Well, it's not huge, but it's pretty big. So within a few days, once you learn these things, and it takes some time and effort to learn them, of course, but you have a lot of sampling going on the chart. So, you get these things, you learn these things, and you can expand them into other markets also if you feel inclined to do so. So why do I do this? Well, as I'd mentioned earlier, I've had the opportunity to live as a trader and to make my living as a trader for about 27, 28 years now. And I've learned so much about trading by running the trading room. And I've actually learned more in the last year than all the prior years combined. And this is due to the sharing. The sharing opens the door for expanding the knowledge and the consciousness. And so we're looking for members who want to learn and get engaged and participate in the expansion of these technologies and the learning. And everyone benefits. It's just amazing what happens when you get a lot of people sharing their insights and what they're seeing on the screen, or people asking questions. Sometimes the simplest questions turn into the most profound things and the most benefit and the greatest learning. So that sharing, what happens is the teacher becomes the student and the student becomes the teacher, and it's just a really empowering kind of a situation and an environment to be in. So, and if you're just beginning, all the better. I have learned from traders who didn't have a clue what was going on as much as I've learned from traders who just totally knew what was going on. So, we call this the smart trend system, smart pattern system that we use in the oil trading room. And so to receive everything that we've learned today and to learn these kinds of patterns and to expand your trading and get you thinking in the future. I've got a special offer today, and also to get your base spreadsheet, I want you to go to oiltradingroom.com/TT, TradeThirsty. Okay. And then if you need to ask me anything, because it looks like we're going to run out of time for any questions today. But if you need to ask, I usually try to get a lot of information into these webinars so you can really get a handle on it. But if you need to contact me, you can contact me directly, Axiom RT, Axiom Research and Trading, axiomrt@gmail.com.
Rob, you can take about 6 minutes worth of questions. You can run a little over. I don't want them to not be able to ask you a couple questions here.
Okay, yeah,
we
guys.
We got started a little late, so it's all you for a minute.
Yeah, we had a little bit of a hiccup there when we were getting started. Now the that link, oiltradingroom.com/TT, will also give you a coupon code for to get into the room for a substantial discount special today. So take advantage of that.
Walk them through that, because I'm seeing a bunch of questions come in. Click on the link.
Okay, yeah, let me open up the questions box. And
so you go to oiltradingroom.com/TT and then...
okay, does your offer include Bloodhound templates? Thanks, Marcus. So we don't, for what we're doing today, when you come in the room, you've got the benefit of all that. You've got the benefit of all that. So you don't really need it. But if you need that, or if you need some help with Bloodhound templates, I'm glad to help you. Marcus is asking about a product that we use from a company called Shark Indicators, and the background color changes on those charts are the software that he's referring to. So. Avi, we have tested this in forex and it works quite well, but for our purposes in the room and for our training, we do it on oil, as mentioned. No, thanks, Al. The charting is there in the room, and so you can do it from there. Trading account wise, the more the better. The more the better. I mean, I get guys send me emails, oh, I just lost my job. I'm going to open a trading account for, $2,000 and support my family or something like that. Please don't try and do that. Please don't use the grocery money for trading. But, you could probably, if you trade one lots, you could, as little as $2,000. I don't recommend it. I'd rather see you have like $5,000 or so. And if you need help setting up an account or something like that, we can also help with that. Yeah, $50. 50 pounds. Yeah. Let me see. I'm just kind of working these backwards as I can. Yeah, you could do this with stocks or any of these kinds of things, Rick. Again, learn it in crude oil, and then learn it in crude oil, and then take it from there. And okay. Now Eric's asking, oh, show us a trade log, an equity curve, and everything else. So here's the thing, Eric. This thing that I'm showing you is not about my performance. It's about your performance. I've got guys in the room that you'll meet. You'll know it when you're in there. I got guys in the room have 95% winning percentages. But there's a huge difference between a guy who's got 100 grand in his account and a guy that's got 2,000 in his account, right? It's a whole different animal. So I don't show you performance because my ability to trade with a large account is going to be entirely different from yours. But a lot of times in the room we're covering money management and things like that that open the door for you to do this. But the success is on each individual trader, and that's you got to learn the patterns and do it. And then usually what happens is traders come in the room for a while, and some just kicking the tires, but others put in the work and do it, and they see that it's working. Like I said, you know, you get a good handful of trades in crude oil on any given day. You should be able to tell within a couple of weeks, a few weeks or a month in the room that it works for you. But the room's about getting you being successful, not about getting me being successful. Oil trading group, no. So Paul's asking about stop size. We get, it depends on how you slice it and dice it. Average stop size with some reasonable skills, about 8 ticks. About 8 ticks. And we talk a lot about honing that down because that adds to your win percent. That's how you get a guy who gets 95% winners. He keeps shaving his stops down to nothing, and his win percent just escalating from that. Preceded, yeah, just meaning before, RB. He's asking about proceed. Also, RB asking about the speed at which some of these things happen, and that is best dealt with by using limit orders. That's another thing, and that's a really good question, RB. Thanks for asking that. So, how do you deal with the market moving pretty quickly? Well, first of all, we're talking about patterns that you know are happening in advance. Patterns that you know are happening in advance. And so that opens the door for you to place orders. If you're reacting to the market, it's going to be harder for you to get really good fills, right? And so the whole purpose of our webinar today is getting you operating in the future so that you can place your orders. But that's a really, really good question. How many ticks is the Renko bar? So that basic structure on some of the charts that we're working with today, a 10-tick reversal bar with a 5-tick continuation bar. Bob's asking, is it strictly for CL? No, as mentioned, you can use that on any market that's reasonably volatile. But we teach it in crude oil because of the number of samples that you get. Number of samples that you get. All right, I think I got them there. Let me look back down at the bottom here. I don't do a free trial for a couple of days, Marcus, because there's no way that you could learn what we're doing in a couple of days. There's no way that you could learn what. And when you come into the room, let me know you're there, because I'll take some time and start getting down to some basics, because sometimes the topics in the rooms can be pretty advanced or pretty simple. No, room runs during pit session hours, so from 9 a.m. Eastern time until 2:30 in the afternoon. You don't want to use it on regular bars, Rosa. As mentioned earlier, bars are really about filtering, and they're about structure. And so if you just throw it on like minute-based bars or something like that, yeah, it'll work, but it's not going to show you what you really want to be seeing. Yeah. Yeah. Michael's asking, do you guide room members with specific high probability setups as they occur? You bet. That's what I do for 2 hours every day. Yeah, and so if you want to trade outside the hours of the room, you can do that, and I can let you know how to do that. Just send an email. So.
All right, Rob, we're going to go ahead and take the mic from you if that's okay here.
Yeah. Thanks for having me, Jeanette.
Perfect.
And
yeah, and I'm going to, when I share my screen, I'm going to show them how to go. I went through the purchase process, and I'm seeing some questions come in, so I'm going to show them real quick how to do that. But
okay, cool.
I'm going to take the screen back from you real quick and do that, and then load up our next speaker. Thank you for spending this Saturday morning with us. Great presentation. And
yeah, thanks, guys, and thank you, Jeanette, very much for having me.
Really, really good feedback. All right, buddy. Talk to you soon.
Bye-bye now.
Bye-bye.
Thank you.